Hello and welcome back to Curly's Trading Blueprint. Episode 6. We're flying through the series. This is going to be the most important episode we do on this series for your trading. 100%. This part 1 of liquidity and part 2. Liquidity is the main thing in our trading. It's in every single trade. It's what we target for our levels. It's why we enter positions. As I've said before, we have a 3-step pattern to how we trade. Draw on liquidity, reverse or bounce or continuation off a key level, and then an inverse with momentum. But draw on liquidity is in every single position. So this video on liquidity part 2 is going to be the most important episode you're going to watch on this series. Let's get into it. Now, we have talked about, I did tease it so far, we did go over liquidity sweep, which is a confluence. So if you watch the liquidity sweep and you know what it is, you would know it's when we sweep out a key low. For example, these lows down here, as I've said, it's wicks that are standing out to you. And that's what liquidity is. I hinted at it and I wanted you to figure it out, and I hope a lot of people have already figured it out from the liquidity sweep video. So this is nearly like a refresher, and now you actually know what it is and why we use it. Firstly, what is liquidity? It's the key high and lows that we're seeing in the market. And I have 6 to 7 draws on liquidity. I'm going to go over some in this video a little later on in the video, and then obviously in part 2 go over some more. But liquidity is the highs and lows in the market that we're looking to target or sweep for price to reverse. For example, if you're looking at this chart, we've this key low down here, that's a liquidity point. We've this key low here, we've a low here, we've a low here. These are all lows, in my opinion, that price could target and reverse off. They are liquidity points. They are areas where we can set our break even, our TP levels, and expect price to target. Liquidity is how the market moves. A lot of people believe it's how the market moves, it targets liquidity. For me, I kind of believe that, but do I care? As I've said, I don't care. It just works to make money and do well trading. You don't even need to know what you're doing here. You just need to follow the patterns and find and get good at trading. You don't even need to know why you're targeting these levels. You just need to know that they work and people can make money trading and target them. But basically what we're looking for is price to sweep out these lows, and a lot of people think to be stop losses under these lows. So people have their positions here, they'll have their stop loss if they were taking a long position here. So we're looking for the trade to come down and take out this low, and what's it going to do? Give us a liquidity sweep. Like we went over in the earlier videos, liquidity sweep this low here and then go back up to the upside, or maybe continue lower depending on the day, on the trade, where the next draw on liquidity is. It still could be lower even though we sweep this low. We're not guaranteed to reverse off every single high and low. As I keep saying on this series, we need to find the right ones. We need to know the right areas for price to bounce off. And the way we trade, we're not trying to bottom and top tick. It's called where you catch when it sweeps it. We're trying to reverse straight away. We obviously are going to wait for the confirmation of the inverse fair value gap setup, along with a few other things, but that is basically why we're looking to take them trades. Now, getting into the 3 draws on liquidity we're going to go over in this video. I'm going to start with the most basic one. Session high and lows. Session high and lows, we're going to go over that. The second thing we're going to go over is swing high and lows. We've already went over swing high and lows really from liquidity sweeps. I've literally just pointed out some swing high and lows to you, but we're going to go over it again just to recap so everyone get a good idea. And then we're going to use trend line liquidity, or LRL, which is low resistance liquidity. We're looking for that to get swept as well, and I'm going to go over that later in the video. Now, session high and lows. As you can see on the screen here, you're seeing UK Ireland time, by the way. As you can see, 1400, so 2 o'clock. I have mine set up for Irish time, as I'm Irish, obviously. What we're looking for with session high and lows is we're looking to mark out for Asia session the highest point and the lowest point between 12 and 8, and for London session 8.5 2 for our Nasdaq. So when I get into it and I mark it out, I'm looking at price here. I'm looking at where we've been between 12 and 8. As you can see, 12 opened right here, and this is clearly the lowest point price went, because that is the lowest point it went in Asia session. Between 12 and 8, find the lowest point on your chart. The best time frame to do this, in my opinion, is the hourly time frame. Go look, and it stands out to you quite clearly there. As you can see, I have Asia low marked out right there. Next thing I'm going to do is mark out Asia high. As you can see, when I look at 12, when I go to 12, 6 o'clock is the highest time for Asia session, because I went and I looked at 12, so 12 started here. Where was the highest point? This was 9 o'clock, so this was 6. So at 6 o'clock price at the highest point in the hourly, so the hourly candle that opened at 6 was the highest point. But as you can see, we've already swept it. We've already took it out. So I won't mark that. We've already had that liquidity sweep. I will mentally know it, and I can mark it out on the chart if I need to remind myself. But for me, I'll know we already swept it. So I don't need to mark that out. The only reason I would mark it out is if there was an SMT there. Remember, we talked about mark out your SMTs. There could be SMTs at session high and lows. So when we're marking out Asia low, Asia high, London low, London high, we're also marking out the exact same on ES. So S&P, as we've talked about, we're marking them out as well. So we have them marked on our chart as draws on liquidity, so we can identify when SMTs happen on ourselves. That might sound confusing. Rewind that and listen to it a few times if you need to understand what that means. But basically, we're marking out exactly what we're doing here. On ES, if there's a difference, one swept the low, one hasn't, one has swept Asia low, one hasn't, then we'll mark that as an SMT, and that could be good to determine our daily bias for the day. That is very technical and a good bit advanced part of how we trade, so make sure you rewatch that part right there if you need to. Next thing I'm going to mark out is the London session. Where was the lowest point in London? Well, 8 o'clock opened here. This is very clearly the lowest point of London, so I'll mark that as London low. As you can see, London low right there. Now we'll mark out London high. Where's the highest point in London? The 1 o'clock candle, as you can see up here, was the highest point in London. Now, that is very simply one of the key draws on liquidity I use every single day. Key areas I mark out for price to sweep and target. London high, Asia low, London low. They are 4 draws on liquidity I can look to mark out. As I've said, Asia high is not marked out as we've swept it, so I don't need to mark it out. But London high is available, London low, and Asia low. And when I let price play out, as you can see, on this day we end up actually sweeping out the London low and London high. And as you can see right here, what happens after we sweep out the London low and Asia low? We end up getting a reaction. So we could have been able to take a position on this day. But that is very simply how we mark out one of our key draws on liquidity. When them areas get taken out, we can use it to then go higher or continue lower. We can see how price reacts off these levels, and they're also good if we're looking to take continuation trades to them. So as I've said, continuation trades, we're pushing towards the draw on liquidity and we're trying to get in on the move. So we'll enter on the move to a London low or an Asia low. If we're looking to take a reversal off them, we're looking for them to get swept or an SMT to happen at them lows, and then we're looking to take the trade back up, maybe up to London high and Asia high or other draws on liquidity higher that we're going to go over later in this video and the next video. Hope that makes sense. Go back now and mark out Asia low, London low, Asia high, London high. Go back and look at the times I said as well if you need to figure out the times for the sessions. As I said, 12 to 8 is Asia, 8 to half 2 is London session. Is London session. So they're the times we're looking to mark out. So make sure you mark out them 4 key levels. As I've said, if one's got swept, which 90% of the time one has got swept in London would have swept some sort of Asia liquidity. So make sure you mark them out on your chart so you have them and they're a key draw on liquidity for us. Next thing we're going to look at is the swing high and lows. To be honest, we've already went through this when we're looking at liquidity sweeps. When I was showing you to stand back and see what wicks are standing out to you, that's exactly what we're looking at. But in this example, I'm going to show you candles to the downside, that is swing low and highs. This candle here was the highest point. We started to come down, we came back up. We have a swing high right here. That could be a draw on liquidity. As you can see, we end up coming down, going back up. Don't really have a draw here. We didn't swing too high. Come back down, swing up. What have we got? A swing high right here. This is just examples of swing high. As we're in a downtrend, we're marking out the highs. Obviously, the lows are already getting swept. So our liquidity sweeps are already happened to the downside. As you can see, we come back down again. We come back up. We have another swing high. And as you can see, we actually get some sort of trade right here that we maybe could take, and it ends up taking out all our swing highs to the upside, as you can see. A lot of times on the higher time frame, some of the swing highs, like that right there, is London high. It could be a higher time frame, as I've said, like a session high or session low. Maybe it could be the start of an unfilled gap. That's something we'll go over later in our videos in the next liquidity video. But swing high and lows, to be honest, are the easiest thing to identify. It's the points that the market pulled back and then went lower in this example. I'm going to give you a bullish example right now. And this is a good example of a bullish trend to the upside where we're leaving swing highs to the downside. As you can see, we put in this one here. We end up pushing up to the upside, make another one here. It's the wicks that are standing out to you. If you were to look at this area here, what two wicks are standing out to you on the downside? This one right here and this one right here. It's genuinely not rocket science to find these wicks and these highs. What stands out to you when you look at your chart? As you can see, we end up coming back up above this high. It is a bit choppy, but as you can see, we do leave another swing low. Doesn't sweep this low here. We end up going back up. As you can see, we end up going back up again. We leave another sort of swing low here, as you can see right there. And then we leave another one right here. So we're leaving loads of liquidity to the downside, as you can see right here. And then, as you can see later on, we end up taking it all out to the downside. All these lows get taken as market starts to pull back to the downside. All these, as this trade is coming down, as I'm looking at this price action come down right here, I can look to take trades to these lows here. These will be TP levels, break-even levels, so on and so forth. These are also swing highs to the upside, so this high or this low here and this low here later on as well will also be it. As you can see, price pulled down, went back up, came back down, didn't sweep this low, so we have this low here, comes back up. This could be a swing low as well. On a lower time frame, it would be a swing low. As you can see, we end up going back up and they all get taken out. So there's loads of draws and liquidity to the downside. It's all the wicks that are standing out to you. When you stand back from your chart and look at, you see these swing high and lows as market structures trending to the upside or downside. We're going to be leaving swing lows and highs behind us. Now, getting into the last draw on liquidity we're going to do, and in my opinion, the hardest one of this video, trendline liquidity. What is trendline liquidity, or LRL? It's where price is bouncing off a line to the upside or downside. Maybe you watching this have seen trend lines before. But for anyone that's new, it's where price is bouncing off a line. It's an imaginary line on the chart. You have to draw it. And price bounces off it and goes back downside. It can't break the line. It's a lot easier to show you what this is than explain it talking. As you can see in this example right here, when I go to the upside, we have this trend line right here. As you can see, when I draw this line out, price is bouncing off this line multiple times and can't break above it. A break above it would be where we like close somewhere like up here. So we've completely broke the trend line. In this example here, we're bouncing off this line multiple times, as you can see. Once, twice, 3, 4, 5, 6, multiple times. And then we end up pushing to the downside. So this trend line end up holding, and we can look to take positions back up to it if we've a bullish bias from obviously a tap into a key area as we've talked about, and an inversion back to the upside. In this example, I'm actually going to show you a trade. So our first example of a trade we could look to take, but this could be used as a draw on liquidity for us because it's a trend line, and this is an example to the downside. As you can see, the trend line, we start bouncing off it multiple times. When we go over here, we actually have a higher time frame sweep on liquidity. So there's just using our sweeps on liquidity we've talked about before. As you can see, this low here gets swept. So we need to see, are we going to react off it and push back to our trend line? As you can see, price ends up coming back up and putting in this swing high right here. Agreed. Price comes up and makes a swing high. I'm going to get rid of this part of the trade for now. Price makes this swing high we just talked about literally 4 or 5 minutes ago. Price comes up, puts in a high, and then comes back down. As you're going to see, sweeping this low once more. So now what do we have? We have another liquidity sweep right here, as you can see. Everyone agrees that's a liquidity sweep from our last video and from what you've seen. We now have a higher time frame liquidity sweep, a higher time frame tap into a fair value gap right here, as you can see. Then we get a lower time frame sweep on liquidity. So we have loads of confluences showing us we're going back to the upside with a draw on liquidity. You could look to enter a trade like this. You could use this high here as a break-even level. So I'm going to mark that as break-even. As this is a draw on liquidity for us, we can use it as break-even or a TP level because it's above 1 hour. But in this example here, I'm going to hold to the top of the trend line. And this is a big play. As you can see, we're going to break even there. Price, as it's later on the session, comes back down but ends up pushing back up. And as you can see right here, ends up sweeping the trend line. For trend line liquidity, we're looking for the trend line for price to come into a key area. As we've talked about, the trend lines are drawing liquidity. Price comes into a key area, and we're expecting a V shape with that inversion fair value gap to shoot past the trend line and end up breaking it. As you can see here, we have it later on, and price ends up going and sweeping it. But we can use these trend lines in all time frames to determine bias on the higher time frame, and on the lower time frame we can use them to take setups. Here's an example of a trend line to the downside. When I draw my line right here, as you can see, price is bouncing off this line multiple times. It can't break it. Yes, it closes a little under it, but we're not breaking it. We're not going under it into these kind of areas here. We're respecting this line and reversing off it. When I go to the 5-minute time frame, as you can see here, it's a bit more clear how we're not closing below it. We're slowly respecting it, as you can see here, and pushing back up to the upside. Then we obviously get our tap into key areas. We get our sweeps on liquidity right here. And what does price end up doing? It ends up coming down in an area like here and taking out all the lows, as you can see here, and sweeping the trend line. This was on Tuesday, and we end up sweeping it later on Tuesday. So that was formed in Asia session, that trend line, and we end up sweeping it in New York session, as you can see right there. And that is how we use trend lines to take trades. Trend lines are something we really need to go practice. There's not much more to them than that. It's just about spotting them and understanding them. And that's going to come with going on the chart, spotting them, seeing do they get swept, when they get swept. On the lower time frame, they tend to go quite quickly. As you can see on the trade I showed, it went within half an hour of making that trend line. Normally it does go quicker than that. In this example here, it was a bit of a higher time frame trend line because it was a 5-15 minute as well. So it ended up going later on the day, but still got swept, as you can see here, and we got a reaction back to the upside. And that is how I use trend lines to take trades from reversal areas, as you can see here, or to target them as draws on liquidity. And that is our introduction to liquidity. Liquidity is the hardest part, in my opinion, of how we trade. It's the hardest part to understand, but I just gave you 3 good draws on liquidity. Go and find them. Make sure you understand session high and lows, swing high and lows, and then trend line liquidity, as you can see right there. Go see when price sweeps them, how does it react, why does it target them, all these different things. Go back test it, go and find it on your chart for yourself in preparation for the next video, where I think next time we're going to go over some more confluences, and then we're going to get back into liquidity. So make sure you understand this before we get going on the next episode. I'll see you on the next episode of The Blueprint. Peace out.